All right, let's go for it. So the focus of the last panel before lunch is non-equity finance. We're going to have a VC panel, a growth VC panel directly after lunch. But what are the perhaps conventional non-equity debt finance solutions available? And we have quite a diverse panel, but I think really interesting. I was speaking to them last week. So let me introduce them. Ciara McGovern is a senior analyst with Beachpoint Capital Management. They have invested in 57 projects here in Ireland, and they have invested 225 million. And in each case, I'm going to let them tell their own story. David Bateman is beside Ciara, and he's the managing partner of Claret Capital, and a concept that I wasn't familiar with. I've heard of equity capital, I've heard of venture capital, I've heard of loan debt and loan notes, but I hadn't heard of venture debt, and he's going to tell us all about that. And we have Clive Lennox of a VC and investor relationships with Silicon Valley Bank. And as you can see, true to form Silicon Valley, it's dressed down Wednesday for Clive, and you're very welcome indeed. And last but not least, Intaval. Intaval, so all the conventional things of raising money for tech firms. How about selling a slice of your IP? How about valuing your IP and maybe doing it on a separate balance sheet? And there's a myriad of actual options there. And the man you need to ring is the CEO of Intaval, Raymond Hegarty. So just first of all, I want to give each of you a couple of minutes just to explain what is it Intaval does and how it might interact with this audience.
Thanks very much, Ivan, for the introduction. I'm Raymond Hegarty. I work with founders and investors like you who are ambitious about growing their companies, and I help to get close investment rounds quickly at higher multiples, or else that we can prepare for a glorious exit. So I do that using various aspects of IP strategy and cleaning up to get through due diligence on those transactions.
And is your background legal, accounting, or what?
It's all of them. I began life as an engineer, and that's a real passion as an engineer, but along the way I've got qualifications in legal, in technical, in commercial, in medical AI, so it's a range of...
So give us an example of a recent case study of what you've done.
Typical case studies, I work with companies that would have valuations of between $30 million and $150 million, and that they have unicorn ambitions. So I'll work with the CEO on developing an IP strategy for capturing intangible value in the company and clearing IP risks to scaling. Because there's a lot of problems that come around success, where you'll have a target on your back and where you have opportunists coming after you and also the big guys wanting to suppress you. So we work through the IP strategies to be able to clear those risks and to scale like mad.
So if you need funding but you don't want to dilute your equity, how can you help?
Oh, there's so many different ways of doing it. Some of the ways, well, like when we talked about this panel being alternatives to equity funding, that you can have debt funding which is securitized by your IP. You can have alternative funding which is based on, for example, as you said, taking a slice of your IP and commercializing it in other ways. Or you can use your IP to reduce your costs and just run your business really well.
How do you value IP?
It's
no EBIT, there's no revenue. How do you value it?
There can be EBIT, there can be revenue, so it can be linked to some future economic value. There are, again, I could do 3 days on valuation, and it is case specific. Is it
subjective or is it?
Absolutely, it's subjective, as in it is subjective. You can have an objectified procedure to come about a subjective result.
Which sounds like smoke and mirrors.
No, it's because it's based on the context. And you have to pull in all of the elements of the context. And depending on whether this is, you're talking about the company, is that you want to finance it, that you want to have a rescue value, that if everything goes pear-shaped, what's left after there's, if you want to have some kind of a transaction.
And is it the full gamut of IP? It could be AI, Internet of Things, GPS technology, biotech, it could be robotics, any of those?
Yeah, it tends to be IP-intensive businesses, which are technology businesses, typical technology businesses.
Software.
Or life science business, or software, or AI, robotics, yes.
Okay. Ciara, tell us about Beachpoint Capital how long you're in Ireland, what you do, what your USP is.
Yes, so Beachpoint Capital have been operating in Ireland since 2018. Our predecessor was BMS Finance, and we took over from them in September 2018. We're a venture debt fund. We provide capital to small, medium-sized businesses in Ireland with typical revenues of around €1 million. Or above, I should say. We can provide capital of anywhere between €500,000 and €10 million, and we're fully non-dilutive equity. So probably slightly similar, but slightly different to the guys here in terms of the approach we take on venture debt. We're fully non-dilutive. So typical venture debt will take a slice of equity as an equity kicker at the end of the investment. We don't do that. We take a fixed exit fee at maturity. And what we found over the years is that Irish entrepreneurs are typically conservative about giving up equity, and so that's one of our kind of key selling points in terms of how we differentiate ourselves in the market.
So I don't understand. You have secured creditors, you have preferential creditors, and you have unsecured. What are you?
We're a secured creditor.
What does that mean?
Senior secured creditor.
Would you be head of a bank?
We are a bank, effectively. So
Right.
we're taking the same security as a bank would in that
And
we
what's
take a
your
debenture.
usual term period?
Our typical term is about 4 to 5 years, and we'll have amortising loans. In some cases, we'll have a bullet facility available. We have typically a 12-month interest-only period at the start, and then it'll amortise over 3 to 4 years thereafter.
And you know the way a bank will say, we love your IP, we value it at $1 million, we lend you $500,000, but we'd like to take your £400,000 house as security.
Yeah.
Do you do that kind of thing?
No, we don't take any.
Well, what do you have for collateral as security?
So our collateral is typically the business, right? So the key thing that we're always looking at, we're backing management teams and entrepreneurs. So if we don't believe in your business, we're not going to make the investment in the first place. So we're looking at businesses that have a clear plan, a growth strategy, and can demonstrate to us that they can deliver on that plan and have a path to profitability.
And what's your typical exit goal?
Our typical exit happens probably, on average, I would say 2.5 years into our investment, and often come
That's very quick.
Very quick, and often come in the form of a trade sale, or in some instances, we've been refinanced by pillar banks. So, our type of funding can provide a track record to these businesses. If a business, for example, is growing through acquisition, some of the pillar banks aren't that keen on those type of acquisitions. We'll come in, we'll fund it in the kind of short to medium term, and Bank of Ireland or AIB might come in at a later stage, and once the acquisition has been done and the business has kind of reached a stable state post-acquisition.
And have you exited any businesses in Ireland yet?
We've exited 17 businesses in Ireland,
right,
so quite a few.
Neat.
Yeah, so we've been around since 2018, but
which is relatively short time.
Yeah, relatively short. Our predecessor was BMS Finance, which had been around since 2008, 2009. So as a kind of a team, we've been around probably in the industry for longer than that. But yes, under the Beachpoint umbrella, we've been operating since 2018.
Okay, David, Claret Capital and Venture Debt. Discuss.
Sure, thanks. Hi, everyone. Ciara covered quite a bit of it. So we also provide venture debt. We're a pan-European fund. We basically run out of London, and Ireland is about probably between sort of 5 and 10% of our business. But I live here, and I want to avoid getting divorced, and my wife likes it when we do stuff here. So we basically have probably overweight.
So you need to grow your personal portfolio.
To grow the portfolio, precisely, yes. And we're also very grateful for the support of ISIF and AIB, and we need to keep them happy too. But I mean, in terms of the actual product and what we do for entrepreneurs here, I mean, Ciara's spot on in some of her distinctions. We would provide a lot of the same type of loans. We probably scale up to somewhat larger. So we would do anything from 1 to 2 million up to 40, 50 million. We probably have about half our business, which is what I'll call, or what we call basically growth finance. So we're essentially financing the organic burn of a company. And I think one of the things to stress is almost all of our companies are burning cash to grow. And in this market in particular, that was a lot more fashionable in 2021 than it is today. So we're still very active. We're actively deploying capital, 2 to 3 deals a month, even in this market, and always have done. I've personally been doing it since about 2002, and Claret is run by myself and another managing partner. In terms of the sort of, I guess, how to put us sort of in the mix, I mean, you heard Tora Dalton earlier. We work a lot with venture capital-backed companies. Nearly all of our deals, not quite all, but most of them are backed by VCs. We also do a lot of work with repeat entrepreneurs. We would have backed Tara's first company, and we also backed her second company. So I think where we maybe distinguish ourselves is we will do relatively deep tech, IP-heavy stuff. We're quite tolerant of burn rates, which in this market is probably unusual. And we'll work with entrepreneurs in terms of the flexibility and the size and the scale. And I think one of the things we offer entrepreneurs across Europe is the ability, if it plays out, to actually back it all the way. We have backed companies from, 6-7 million up to 200-300 million of revenue. And that's probably something that is easier to do when you do it from, if you like, a pan-European perspective. And a lot of the entrepreneurs are going for that, and that's something that we like to focus on.
And would you take a seat on the board?
No, a bit like Ciara was saying, we're a senior secured creditor, so in general, for two reasons, one is entirely selfish, which is that if you have a seat on a board, it's hard to remain a secured creditor. And the other reason is that, frankly, we're backing businesses that we've bought into the governance, we've bought into the board direction and the strategy, and we would rather be in a situation where we're providing, if you like, capital as fuel, than necessarily trying to tell the entrepreneurs how to run their business.
Okay. But presumably you don't provide free capital, so how much do you charge?
No, we don't. Pricing, and people can comment on it on the venture debt, there's usually, an interest cost component which ranges from 9 up to about 12%, depending on risk and stage. And as Ciara pointed out, we do take equity kickers in all the deals. We will take very small slices of the equity. You're talking sub 1%, sub 2%, but we believe it's interesting to back these businesses all the way, and that's what our investors have backed us to do.
But typically, are you waiting for the exit for a repayment schedule?
Yes, yeah.
Like you don't have to pay so much every half
year? The loans will be repaid generally over 3 to 5 years, depending on the timing.
In one end payment?
No, they vary, so they can be, that structurally varies quite a bit, but generally speaking,
so it could be a monthly direct debit?
They're nearly all paying monthly interest. And then the actual repayment of the loan might be over 3 to 4 years.
Okay. Welcome, Clive. Silicon Valley Bank, discuss.
Yeah.
And Ireland.
Yeah, thanks, Ivan. Thanks for having me. Hello, everyone. And I thought I'd get away with your glare by wearing a bit of dress down today, but I haven't escaped from being a banker. So from Silicon Valley Bank's perspective, we're a global debt, primarily kind of growth debt and financial service partner to a large proportion of the world's best tech and life science companies. From an Irish perspective, we provide debt financing at every life stage of a business, so from early stage through to larger public and private businesses and everything in between. So that's probably one of our unique selling points from an Irish perspective. We're at each life stage of the journey for a business within an Irish profile. To date, we've lent around just in excess of $500 million to about 35 Irish companies, and that's across the full spectrum of venture debt, working capital, acquisition financing, leverage financing, more corporate side facilities. So we're kind of across the full range.
How are you different to one of the pillar banks here?
Well, it's probably if you look at our portfolio, like we're comfortable like in the early stage looking at cash burning businesses. So businesses that have no intention of like reaching profitability and will exit like at some point on that journey. Will finance, we're more aggressive in kind of maybe software where we're kind of comfortable with high IP, high margin businesses where maybe the pillar banks, that's probably not their bread and butter. And if you look at kind of we also work around 2,500 investors, so kind of the who's who of venture capital globally. We're kind of really deep into their portfolio in terms of what they're doing, what they're trying to achieve and solve for, and we kind of like work as a kind of a big, large kind of innovation community in terms of how we want to proceed with companies.
Where do you source your own funds?
We're publicly listed. We're listed on the NASDAQ, so we're a big bank now. So we're probably, I think we're like one of in the top 20 largest US banks, and so we're balance sheet funds.
Well, a good time to start. You know, the NASDAQ is a bit of a bloodbath at the moment.
Well, I'll give you an insight, Ivan. If you follow our stock, it's probably a good indication as to how tech's performing. So we bank about, I think it's about 60% of all equity-backed companies in the US are clients of Silicon Valley Bank. So a good indication. It's not like that's not exact, but we're on a bit of a rocky ride as well as most tech is at the moment.
So are you dealing with down rounds or what?
Yeah, we're dealing with everything. Like it's depending on the sector. Like I'll go enterprise software team. I was on a pipeline call with them yesterday, and they're never been busier. So it really depends on the vertical in terms of where companies are struggling, where they're performing, where like conversations are definitely harder now than they were 12 months ago. So we're seeing companies that are struggling, we're seeing companies that are accelerating, we're seeing the full gamut.
But we heard, some do's and don'ts from Good Buddies earlier in terms of, the show is on, you better be all singing, all dancing. What advice in terms of the Irish market, how do you think in terms of selling their story, the enabling piece that we heard of Ultratech, the multiplier effects and so on, how good are people in front of you telling their story and what could they do better?
Yeah, if we look at, I'll concentrate primarily on the early stage stuff because that's what I think the four of us here have spent a lot of time doing. So the kind of earlier stage businesses, the number one thing for me is the quality of what we're seeing from when we go into DD. It's the quality of the financials, the models, like how realistic it is. Like it's having that correct, looking good. Oftentimes it's not, and I think that's a really important piece to come to the table when you present it to someone. When it goes outside of your own team to the public, it needs to be spot on, it needs to be right, it needs to be realistic.
If it's a pre-revenue model, do you do pre-revenue?
In pharma, I don't know if we've got time. We lend to companies pre-revenue, yes. It's primarily in pharma, so there'll be big equity rounds around it. So if that's less in the forecasting. If anything, they may never make a dime in their life before they exit to one of the big pharma companies. So it's a different type of lending, but we do pre-revenue.
And what do you charge for your funds?
We're similar. It's probably Dave kind of covered it pretty well. Like we're about 10% from a venture perspective, and then all the way through to like it's like sub 2% for larger companies. So it just depends where you are on the risk spectrum and where you are on your life stage of journey.
And it strikes me in terms of innovation. If you take something like robotics, and say the pitch is that everyone is now doing remote shopping, and so Amazon and everyone have these huge warehouses. So we're going to 95% are hand pickers. We're going to do robotics, and it's going to change the world, and it's going to be more efficient. But then you find that there are 5 companies doing it, and it ends up 5 years later there's only one winner. How do you pick the winner?
We don't pick the winner, and oftentimes we bank all of them. So that's kind of if you look across, it's very rare that a company will come to us that something very similar doesn't exist already. And actually we get comfort from that because we know the metrics, we know what's good, we know what's bad, we know like when to lean in, when not to. So more often than not, we like when we're working with companies, there could be like 4, 5, 6, 7 similar companies that we're working with globally, and that to us is a
So your business model is of 5, one could be a Facebook, one could wipe its face, and the other 3 could die.
Well, the beauty is, like, we're not equity investors, so we don't take equity risks. So we're not looking for winners. We're looking for companies that stay alive. I think I love the someone they're trying not to die. So we're looking for companies that stay alive, and we're looking for debt return. It's like, and we're not looking for exits. If you continue being our client for 10, 20, 30, 40 years, that's even better for us because we've got debt instruments that will follow your journey from early through to whatever you may become as a larger business. And we add from a debt perspective, we're just taking an interest on the capital that we provide across those, like, hopefully decades.
So we call you in, Raymond Hegarty. How do you do your due diligence? In other words, how do you know that you value this piece of IP at 50 million and, or whatever? And how do we know that you're robust?
How do I know that a client is robust?
No, yeah, exactly, that your valuation is robust.
Well, valuation, I don't want to get too hung up in valuation because valuation tends to be just describing a number. And a lot of people get very comfortable when there's a number ascribed and then they think it's all over. But it's all about context, as I said earlier on as well. And you want to make sure that you have all of the procedures in place, the processes in place, and that you have all of the...
Well, talk us through some of those.
Okay, well, the first thing is that most companies, when they think about IP strategies, they'll often think about patents. But a huge amount of the intangible value is tied up in non-patent IP as well. So you're talking about patents, you're talking about trademarks, you're talking about trade secrets. Then there's a whole lot of intangible value tied up in company reputation, company status, all of those things. So we will do a full audit on all of the intangible assets that the company has. First of all, to make sure that they actually own those assets, because very often they may not. A title, when you buy a house, title can be a problem. But if you're acquiring, for example, a patent from somebody, 60% of the time, there's a problem with title on acquisitions of patents. So you go through the title, you go through the employment contracts of the employees. If it's, I work mainly with scale-ups rather than with startups. But what you'll find with a scale-up, that when it's going to the next phase of investment, that you've had people coming in at different times into the company. They may have different contracts of employment, and you may need to harmonize all of those contracts before you move on to the next phase. And that can be a difficult conversation to have with the founders, because it tends to be the founders' contracts that need to be updated to get it in line with everybody else. So those types of simple, practical, early wins. Then the next thing we look at is, what are the IP risks to scaling? Because as I was saying, that before you're successful, nobody cares about you. When you're a small startup, you don't have any money, nobody's going to sue you because there's nothing to come after. Nobody knows about you, so they don't come after you, and you're not a threat to anybody. But as you grow, you have all of those problems of success, that you'll get opportunists coming out, you'll get patent trolls coming out, you'll get competitors coming out, you get the people who are trying to copy, you've got disgruntled former employees, but you'll also get the big guys who are trying to suppress you in your success. So what kind of IP strategies do you have in place for that IP risk management? So all of those things, we will look at those and put them together and build a concrete action plan around that and then execute on that plan.
And in the process, how can you protect about someone robbing your IP?
There's, again, whether you're talking about, if it's something which is patentable subject matter, you may decide to patent it. But if you go to a lawyer or a patent attorney, very often they'll tell you straight away to patent it. And that's because, the Maslow's hammer, that everything looks like a nail. But we look at things like, trade secrets are very, very powerful now. That the legislation has moved on in Europe, in the USA, in China, in Japan, over the last 5 or 10 years. You can go to prison in the USA.
Litigation could take 3 years.
Yes, but for example, for trade secrets, that if somebody leaves your company, you need to know very quickly what trade secrets they had access to. Because in this digital era, if they walk out with a USB, in 24 hours, this could be disseminated to the world and the damage could be done. So you need to have an action plan to know what are the risks that are around this person leaving, what trade secrets do they have access to, what could they do with this, and what actions could you take? And very often you'll have to take actions within 24 hours. And in the USA, for example, that might mean bringing in the FBI, and we've got contacts in the FBI as well for handling that, because you've a combination of trade secrets and industrial espionage.
So how is IP as a commodity to trade? I mean, is it a liquid market? I mean, is it subjective in terms, we spoke about valuations, but I mean, is it transactable? And therefore, if you sell it, have you not sold the sort of golden share in your company?
You don't necessarily need to sell every time, and again, I don't know the stage. You could license it. You can give access. There's every intangible asset you have has got multiple uses, and if you're using an intangible asset just with a single use, you're probably missing out on multiple options for extracting the most value from those intangible assets. So we will look at all of the different avenues for extracting value and giving a second life to that intangible asset.
Ciara, we've heard of the top line, change from bull to bear market in the Nasdaq and so on. What's your outlook for 23 for Beach Point?
Look, we're very busy. We're probably getting more deals through the door than we've ever seen before, and I think that stems from a slight softening in the equity markets in particular. I suppose the reason...
Sorry, valuations have come down or what?
Valuations have come down, and I suppose investors are becoming a little bit, more reluctant in terms of the speed, and they're probably being slightly pickier in the investments that they're choosing. But I guess from our perspective, one of the key things one of the kind of key models that we always operate on is moving fast is really, really important for businesses and for entrepreneurs. Opportunities do not wait. As I think Don mentioned it earlier, if a business has an opportunity, it doesn't wait, be it, growing into new markets or buying an acquisition. Those things can't wait. So what we try to do is facilitate businesses to continue to grow and move fast. From meeting a business on day one, we can fund within 4 weeks of first meeting them. And I think that provides a lot of certainty of execution to businesses and allows them to continue to grow even when the market is somewhat challenged.
David, prospects 23?
Yeah, I mean, look, it's, we think from a selfish point of view, it's a very interesting time to invest. I think the observation we've had, and we've been through 2008, 2009, and Firma since 2002, is that the entrepreneurs are actually incredibly resilient, and the ecosystem is very resilient. In fairness, Ireland is actually relatively well positioned. It mightn't always feel like that to people, but if you look at where these changes in valuation have come, they've overwhelmingly come, and headline really is consumer internet, which actually is not a large part of the market in Ireland. In fact, Ireland has a lot of deep tech, has a lot of B2B. It isn't as exposed as maybe other parts of Europe is. So that makes it a relatively attractive place. And I think, the entrepreneurs will have to a certain extent, adjust. but I don't think it was as out of whack here in terms of the business plans of people as maybe it was in other places, in particularly the UK and Germany. So, I mean, we think it's going to be a very interesting year. We already have a pipe. We closed a deal here about 4 or 5 weeks ago. We funded a business called Grid Beyond out in Blanchardstown. And we've also seen exits. I mean, if you're in the right position, you can sell. Roomex, which was one of our portfolio companies, it exited about 5 weeks ago to FleetCor. And it got a very nice return that has every investor happy. So it is about being resilient, adjusting, being agile, and it's the most adaptive. And historically, entrepreneurs are very adaptive.
Okay, you mentioned Roomex there, Avi Medical, Razor, Ultratech, Longboat Clinical, WeFox, Grid Beyond.
Yeah.
They're
all. I mean, all of those are thriving businesses. We have 140 businesses in the portfolio. They're not all having a good day. Some of them are not. But it's more a point for the entrepreneurs is just that kind of the sun comes up in the morning. This is a cycle, and the cycle isn't endless, and so they should be, I think, probably travel hopefully.
And given the array of debt and equity opportunities, is there any kind of typical, for a fast-growing company, rule of thumb, Clive, in terms of you have, out of 10 million of capital raised, so much equity, so much conventional bank debt, and so much venture debt? Is there any rule of thumb?
There is, yeah, and this can change. But if I'm in a meeting, I just want to give people a sense to what that capital debt could look like from an early stage business. And this will differ depending on the provider. We're about at 30% of the equity round in terms of what we'll put forward from a venture debt perspective. So in simple maths, if a company raises 10 million in equity, we could be an additional 3, or we could be 2 of the 10, so 8, 2 to get you 10, or 10 plus 3 to get you to 13. So that's a decent rule of thumb in terms of how we look at venture debt in a deck a deck of capital.
And just say a sweet spot is cyber security tech, and someone says, mine is fantastic. How do you assess that?
Yeah, so if you look at it, and actually the security tech, it's a broader point now. If you look at our underwriting and where are the companies mission critical or are they not? And cyber tech kind of comes into that mission critical perspective. But if you're looking at early stage businesses, and we like to spend a lot of time looking at what the business is, where they're playing. Do we know the sector really well? Who's coming onto the onto the cap table? Are they seasoned equity guys and girls? Do they know what they're doing? Have they got track records? Will they support the company in good times and most importantly in bad times? So that's where our DD spent a lot about getting to know who's around the table, where they're playing, and do we know the space well? And that allows us to either lean in or back away.
Okay, I'm going to conclude because we're over time for lunch, but best bit of advice you ever got or you'd like to give to this particular audience of financiers and entrepreneurs? We'll start with you, Raymond, and work along.
Well, the simplest thing is that for high-tech companies, life science companies, that you have a huge treasure trove of intangible value within the company that you may not even know about yourself because it's not recognized typically on the balance sheet. But there's a lot that you can find in your own back garden and that you can commercialize.
Right. That sounds wonderful.
It is wonderful. You can see my passion. But
yes.
There's just the depth of possibilities within companies that is untapped. Now, it's a tragedy that it's untapped, but at the same time, it's a huge opportunity for people to actually go out there and actually exploit the things that they've put already their efforts into building.
Well, I'm thinking when you say that of Kieran and his robotics and his ultraviolet light cleaning system, would he have, they're not Egypts insofar as that they probably know they have this value on the balance sheet and their investors know that, and that's why they're investing it. So delineating out the IP is maybe not a simple process.
Well, with respect, even if you think the people are not Egypts, they may not be exposed to the possibilities. There's a huge amount of, even though we talk about the hesitancy worldwide, there's a huge amount of dry capital out there waiting to be deployed. They're looking for quality right now. So if you are a quality company, you'll rise above all the noise of all the other ones that had been desperate for money up until now. But the quality ones are standing out. And the companies that are the investors that are looking for good value are really wanting to get back into the market now.
Okay. Best advice?
Yeah, I think Ireland, in terms of entrepreneurship, it's phenomenal. Like, it's world class, and that's part of my role. It's like banging that drum. I spend a lot of time in the US and Europe, and it's just making sure that the companies here realise like how good they are and how good they are in terms of their performance and their ability to deliver. Like Irish entrepreneurs are recognised throughout the world, and I think it's that ambition piece. Like, and I've seen it grow. I'm back. I was living away for quite a bit and came back about 4 or 5 years ago, and I've seen it year on year getting bolder and better and more aggressive and reaching for the stars, and that's something that I really would encourage. Like, you know, don't limit yourself to the islands of, like, this is a global platform, and just be more ambitious than you kind of originally set out to be, and go for it.
But if Ireland is so full of entrepreneurs, why do you limit yourself to tech and life sciences?
Well, that's our kind of USP. We know tech, we know innovation really, really well, and if we don't want to play in kind of real estate or commercial property, we've built a community around this, and we think we're really, really good at it.
It's because what you're good at, that's the reason. It's not that there aren't opportunities in pharma or in engineering or infrastructure.
We've tried a few different things over like, we're 40 years old. We've tried a few different areas, and we probably got burnt a few times, and then it was a real like.
So if I came to you with the best offshore wind farm idea that was guaranteed to make money, you wouldn't be interested?
Well, we have an energy arm too, so I'll send you there, Ivan. So yeah, maybe.
Okay. Advice, David.
Best thing I've heard over the years is, always spend the capital you raise as if it was your own. And, a lot of entrepreneurs over the last few years, they had a lot of money thrown at them, and they had to build a company, or they felt they had to build a company a certain way. And now that's changing, and people are having to adjust. But I, in general, think if you follow that rule, you generally spend it well. And that's actually how you build a business. Most people will raise money sooner or later, but it's how you spend it that determines where you succeed.
And do you take a role in...
We don't.
If I borrow money for a factory extension, or if I buy money for a piece of kit, do you actually say, well, this is what you're going to spend the money on?
No. I mean, the phrase about what we do is it spends like equity. And we're a team of 20 people with 140 portfolio companies. We cannot, even if we wanted to, and even if we had the skills, which we probably don't, we're not in a position to even just tell the entrepreneurs what to do.
That is like a bank would never behave that way.
We meet them on the way in. We take a decision, are we going to back them or not? And then we're kind of along for the ride after that. So which doesn't always work that well.
If you fall off, you have a great sense of humour and all that kind of
thing? That's when the security comes in, but yes. But we never take, to what Ciara said, just understand, I mean, because I know a lot of people in the room will remember 2009 and here and banking system, we never take any form of personal guarantee, and I don't think anyone on the panel ever does. That's something that nobody does in this industry.
Okay, finally, best advice, Ciara?
Well, I'm an accountant by trade, so I'm going to have a finance answer in all reality. So I think investing in your finance function and being well prepared when you're looking to raise equity is really, really important. There is no level of preparedness that you can't go beyond as far as we're concerned. And look, that doesn't always come, what I would say is it doesn't always have to be in the form of getting advisors. For small businesses in Ireland, appointing an advisor is an expensive exercise. But what I would say is, have well-constructed plans behind everything when you're going into an investment process, and make sure that you're creating a plan that you can back and also deliver on, and have a clear path to profitability when you're going in looking for debt lending in particular, I would say.
Do you prefer advisors involved?
At early stage, well, there's a few in the room here, so yes to the guys in the room. And early stage, it's probably not required too early, but at a point, advisors are very, very useful. But
a lot of deals come through advisors, and we don't really mind either way.
So it's not a prerequisite?
No, absolutely not.
All right, I've certainly learned a lot, so there you have a number of options that you can consider which don't dilute your equity stake in your great company and your great IP. Please show your appreciation for Raymond, Clive, David and Ciara. All right.